Welcome. In this today's video, we will be discussing on central bank operations and financial system stability. Prior to implementation of cost reflective pricing mechanisms, banking sector was often required to finance loss-making state-owned enterprises known as SOEs. But this practice has now been addressed and there will be no more direct financing for SOEs to cover their losses. Further, CBSL has asked commercial banks to reduce their exposure to SOEs, particularly their large exposures as stipulated in new Banking Act. Financial sector has had to endure difficult macroeconomic conditions over the past 2 years, but it has remained resilient throughout the crisis. At one point, there were significant concerns, particularly from IMF and World Bank, about the possibility of a banking crisis, especially given the sovereign debt crisis, the exposures of state bank to sovereign debt, and the deterioration in the asset quality of commercial banks. However, CBSL has worked diligently with the banking sector to strengthen resilience. Now, all the key indicators are improving, namely capital adequacy, liquidity, and non-performing loans are on a recovery path. During this period, Central Bank has implemented several important reforms, including amendments to Banking Act, which have strengthened regulatory and supervisory oversight of Central Bank. Central Bank has conducted an asset quality review for all large banks. Based on these assessments and using forward-looking stress testing tools, now confident that the banking sector, with the exception of the 2 state-owned banks, is well positioned to build its own capital without relying on taxpayer funds. 2 state banks, however, will need some support from the government. IMF program allocated 450 billion LKR to help recapitalize these banks if required. Latest assessments suggest that the full amount may not be needed. In fact, around 1/3 of this allocation may be sufficient to address any potential capital shortfalls arising from restructuring of their forex obligations. Forex debt restructuring of state banks has progressed, and once Parliament ratifies necessary measures, expects final phase of restructuring to be completed by end of this year. Starting next year, government will face a significantly lighter debt servicing burden, and banking sector will be in a much stronger position to support economic recovery. With sufficient capital and liquidity, banking system will be better equipped to drive economic growth and offer businesses and households financial support they require. In the case of banking sector, Special Provisions Act, which was also passed by Parliament with the aim of establishing a resolution framework in the event that any financial institution faces solvency or liquidity issues. This new framework empowers central bank to implement resolution process promptly and effectively whenever need arises. In conclusion, building a stronger and resilient economy requires continued collective efforts of all the stakeholders, namely monetary authorities, fiscal authorities, and others including private sector and the general public. With that, we will be concluding, and thanks for watching.